Let's dive right in. Welcome to This Explainer, where we're going to decode what was honestly the craziest week of 2026. We are looking at a week where the total euphoria of a geopolitical peace deal violently collided with some seriously hawkish monetary policy, all in the span of just a few days. We're talking about a historic, head-on crash between two massive macro forces that left the markets completely scrambling.
Talk about whiplash. Over the course of just 72 hours, oil crashed by double digits, the Dow hit all-time intraday highs, and then, bam! A brand new Federal Reserve chairman stepped up and shocked the entire financial system with a massive reality check. It was a 4-day trading week that literally felt like it lasted an entire year.
So, here is our roadmap for today. We'll start with the collision of macro forces, move into the Warsh Fed shock, then check out AI's power and infrastructure. Look at how Wall Street moves on chain, and finally wrap up with the inflation test ahead.
Starting off with Section 1, Collision of Macro Forces, the Market Whiplash of June 2026.
Okay, this timeline really anchors us in the madness of it all. Picture this. On Monday, an Iran peace deal sparks massive optimism. A toll-free Strait of Hormuz was seen as a huge economic win, right? But fast forward to Wednesday, and that whole travel stock euphoria violently collided with Kevin Warsh's surprisingly hawkish Fed dot plot. It actually wasn't until Thursday that the market finally took a breath, stabilized, and kind of realized, okay, a hawkish projection doesn't necessarily mean an immediate rate hike.
10%. A staggering 10% plunge. Oil dropped from $84 down to $76 almost instantly. It's like a massive supply shock was suddenly just removed from the system. And the market's response? A violent rotation. Energy stocks, which are your traditional war beneficiaries, tumbled, while airlines, cruise lines, and tech stocks totally surged because, well, their biggest input costs just dropped. Moving on to Section 2, the Warsh Fed shock, a new era of monetary policy.
We are witnessing a drastic regime change at the Fed. Think about it. Under the previous administration, markets heavily relied on these 400-word statements filled with all sorts of nuance and conditionality. Well, Warsh essentially took a pair of scissors to that. He stripped out the easing bias entirely and slashed the statement down to a bare-bones 130 words. The message here is loud and clear. The central bank is under entirely new management.
And it really all boiled down to these definitive 6 words. The committee will deliver price stability. Just think about the gravity of that for a second. The median year-end rate forecast actually moved up from 3.4% to 3.8%. And in an unprecedented move, Warsh even refused to submit his own dot on the plot. That is a first for a sitting Fed chair. He made it crystal clear that his absolute focus is inflation, regardless of how much it might hurt the market in the short term. So the bond market's reaction? Completely violent. The 2-year Treasury yield spiked 16 basis points instantly. That's the largest single-day move we've seen all year. Short-term rate hike expectations repriced incredibly fast as the market desperately tried to digest the fact that the easing cycle they had been betting on was, well, officially suspended.
And equities felt the exact same whiplash. The Dow absolutely plummeted 507 points in just 90 minutes as traders scrambled to reprice stagflation risks. Remember, this is the exact same Dow that had just hit an all-time record high barely 48 hours prior. The Fed officially raised its PCE inflation forecast to 3.6%, while simultaneously revising GDP growth down. So yeah, stagflation is squarely back in the conversation.
All right, Section 3, AI's power and infrastructure, the unstoppable trade.
Now, despite all that broader market panic over rates, the structural rollout of AI proved to be completely unstoppable. Let's look at the entities that practically ignored the macro chaos. Index buying forced NBIS to new all-time highs, even on the day the Dow dropped 500 points. They gained a staggering 21% on the week just because every index fund tracking the Nasdaq 100 was obligated to buy it. Meanwhile, Bloom Energy jumped 15% in a single day. Why? Because the massive AI build-out is running headfirst into a very real physical wall: electricity.
$20 billion. Let that number sink in. That is Bloom Energy's contracted backlog, which represents 10 years of secured revenue. What they do is build these high-efficiency solid oxide fuel cells that convert fuel, like natural gas or biogas, directly into electricity without combustion. They're getting 65% efficiency and operating at incredibly high temperatures. So for data centers that are just demanding endless electricity, Bloom offers a way to generate power right on site, entirely bypassing our super overburdened traditional power grid.
If you want to understand why they are up 219% year-to-date, just take a look at this list of clients. We are talking credit-worthy hyperscalers and utilities who simply cannot afford to wait for the traditional grid to catch up to AI's demands. Oracle is using them for their massive AI data center initiative. Brookfield made a $5 billion commitment. American Electric Power placed the largest utility order in Bloom's entire history. These aren't just theoretical little pilots. These are multi-billion-dollar contracts from major institutions who are realizing that bring your own power is now a mandatory requirement for AI.
Which brings us to Section 4, Wall Street Moves On-Chain, the Stealth Institutional Revolution. While the AI power grid was busy being rewired, the traditional financial system was quietly accelerating its own structural rewiring by moving deeper into crypto architecture. Let's take a quick second to clearly define tokenization here, because Wall Street is no longer just experimenting, they are turning this into real consumer-facing products. The days of crypto just being a speculative side quest, those are ending. It's now literally becoming the underlying plumbing of the broader financial ecosystem.
Frictionless institutional on-ramps are quietly being built everywhere you look. Just check out this pipeline. Franklin Templeton is building a product where your traditional stock dividends automatically buy Bitcoin. That allows conservative portfolios to slowly build crypto exposure without forcing you to make a new, conscious buying decision. BlackRock is selling covered calls on spot Bitcoin to generate monthly income for yield seekers. And Coinbase? They're creating one-to-one backed tokens of actual U.S. equities, meaning you can trade real shares 24/7 with instant settlement. It's wild.
But this split reality tells us exactly why Bitcoin couldn't actually hold on to its Iran deal rally. Unlike tech stocks, Bitcoin is uniquely sensitive to the higher rate environment that Warsh just promised us. It initially spiked to over $66,000 on all that geopolitical optimism, but quickly reversed course. Why? Well, because it produces no organic yield. When the Fed signals higher for longer rates, non-yielding assets get punished, and they get punished fast. Equities, on the other hand, have earnings growth that can potentially outpace those rising borrowing costs.
Finally, Section 5, the inflation test ahead, the next big catalyst.
And this brings us directly to the future and to the crucial economic data drop that's going to determine which of these two colliding macro forces actually wins out. Absolutely all eyes are on Thursday's PCE inflation report. This is the Fed's preferred metric, and it's the very first major data point under the new Hawkish Warsh regime. Economists are expecting an acceleration driven partly by energy costs that haven't quite reflected the recent oil crash just yet. The tension here is incredible, folks, because this data drops just days after the Fed explicitly told us how concerned they are about inflation.
So here is your exact playbook based on Thursday's outcome. If core PCE comes in at 0.3% or higher, the market is going to treat the Fed's hawkish dot plot as absolute gospel. An October rate hike becomes the heavy favorite. But on the flip side, if the data surprises to the downside, dropping below 0.2%, the narrative softens. The Fed gets a little breathing room to let falling oil prices do the heavy lifting, which gives risk assets, like tech and crypto, a massive green light.
So, as we watch the portfolio absorb all these historic crosscurrents, I want to leave you with this final, defining question to ponder for the weeks ahead. Will sticky inflation force this new, unyielding Fed to follow through on their threat to hike, or will the massive deflationary dividend from geopolitical peace ultimately save the market? Thank you for exploring this fascinating collision of data with me. Keep watching the numbers and keep learning.